Hello, Mark. Welcome to Options Brew Market Shot. We have Mark Phillips coming to us from his home somewhere in Chicagoland, and me somewhere in Chicagoland. How are you, Mark? Welcome.
I'm good, Lex. How are you? Happy Thursday.
Happy Thursday. Thank you. Well, so we're continuing on in the series. We're calling it the Traders Workshop on Options Brew, right? We've kind of talked about some synthetics, some things that you probably wouldn't get in the normal course of things. Kind of ways that you and I grew up in the industry on the trading side, synthetics, understanding relationships, etc. And today we're going to take it another step further. We talked about boxes a couple episodes ago, and today we're going to talk about the roll, right? A jelly roll. We used to call it a jelly roll. So I'm going to turn it over to you, Mark, to go into it. But that's what we're going to go with today, right?
Yeah, and I think understanding, like you say, understanding these synthetic relationships is just so important to getting a read on what's going on in the market. That while they might not necessarily be something that you're actively going to be trading, you might not be buying a jelly roll or selling a jelly roll explicitly. It's important to understand why that pricing exists out in the market, and it gives some interesting kind of indications of what people are thinking about the stock. And it's
Right.
in this specific case, its cost of carry is really going to be the core component here that the jelly roll highlights.
Yep. Perfect. Okay. You have an example for us today?
Yeah, so I did pull up an example in Tesla. But before going into the specific numbers, I think we can think about a jelly roll, like you said, is very similar to a box. So a box, remember, is that spread where you are long synthetic stock on one line and you're short synthetic stock on another. Now
Right.
that's all within the same month. And we talked about building the box by, building those different, long and short synthetic stocks. We talked about doing it with call and put spreads. And we can think about a jelly roll in very much the same way, except for it's across months. So it has to do with the difference between the cost of carry of two different months. So we're going to be looking at the same line across, two different times to expiration.
Right.
So, one way to think about that is that you're either long or short month one synthetic versus short or long month two synthetic. So a long jelly roll would be long the back month and short the front month synthetic. And a short jelly roll would be the opposite, where you're short the back month and long the front month.
Got it.
And so again, we can think about that in terms of synthetics, but then we can also think about it in terms of time spreads, because fundamentally that is what we're talking about here is time and the cost of carry and the difference between these, the 2 months cost of carry. So a long jelly roll would be long a call time spread and short a put time spread. And then the short jelly roll would be the exact opposite, where you're short a call time spread and long a put time spread.
And again, across time, right? Yeah, you mentioned the time spread part of it, right? Okay, good.
Right. So I just pulled these markets up in Tesla. This is from a little bit earlier today, and I chose Tesla because it's a high dollar stock, so it's really easy to see the sort of cost to carry here. And so if we're looking at the 690 line, which is, at the time Tesla was trading around 688.95. So some quick sort of synthetic math. Let's sort of confirm that the combo or the synthetic stock on the 690 line is priced correctly. I have the market and the call is 34.75 at 95. So let's say that call is worth about 34.85. Let's say this put's worth about 35.90. So 34.85, 35.90, $1.05 on that combo for July. $1.05 on the 690 line comes out right to 688.95.
Okay.
So that combo, true to stock, we've got that combo in the July.
Got it.
In October, so we're going all the way out to October 15th serial expiration. I have the calls worth 84.65, and I have the puts worth 85.20. So that combo is actually going to be less. So it's a little counterintuitive that the combo in October is actually only going to be worth 55 cents right now, which is less than that combo in July of 105. But that's because of the cost of carry. That's because that you have to hold that stock all the way out to October.
And that would be once we get assigned on the front month, it would be short stock we're getting, correct?
Exactly. So to hedge this all out, if you were long the combo in October and short the combo in July, July your short combo rolls off. You need to hedge that by being short stock. in a positive interest rate environment, you'd be collecting the interest on that
Right.
over the course of, the duration between July and October. That's going to be about your 50 cents, which is what this jelly roll is priced at.
Right. So you're defeasing the cost of that second month, that farther out month cost, because it's not exactly parity with the stock. It's above it. So you're paying more for the synthetic part of the stock, the long stock, to offset that short, but the short interest reduces whatever that number is back to parity. So a little bit of a little bit of a brainy concept that we probably don't think about too much, but it absolutely is in play in every account, in the brokerage business.
100%.
Yeah.
And so the cost of this long jelly roll, if you were to sell the 105 pay 105 and sell the 55, you're 50 cents. And that in this case is only going to be interest, but dividends can also come into play here. So dividends are an important risk to think about also when you're thinking about these jelly rolls. And as with all these synthetic relationships coming around to the cost of carry, interest and dividends are going to represent that cost of carry. So if, for example, Tesla were to announce a dividend sometime between July and October, that's one of the risks of this position. If you're long the jelly roll, a new dividend or a higher dividend or raising the dividend that you're pricing in would, make this trade a loser, because you're going to have that short synthetic stock, or you're going to be long synthetic stock, short actual stock, which presents that dividend risk out to October.
Got it. Okay, here's what I did. I'm gonna actually take some things out too. Let's start over. So what I have it set up in here. So I have the whole jelly roll in here, and it's all 4 legs. But let's go through it just step by step. I'm gonna clear it out. Okay, we were talking about the 690. So just keep in mind too, the prices have changed when Mark put this together versus where it is now. So Mark, help me. I'm gonna be short the front month call, long the front month put. Is that correct?
That's correct.
Okay,
and that would give you a synthetic short stock position.
Yes, so this is going to be synthetic short stock. So you can see it when I put it in. It says synthetic short stock at the top. Okay, it's a combo, whatever you want to call it. There's all kinds of names, but synthetic short stock. Okay, so
and you can see that combo is priced around 427.
Yep.
And with stock trading around 694, 27, 28, that's exactly where that price comes.
That's right on. Okay, now let's go out to October. Okay. And now what I need to do is I need to do the opposite. I need to buy synthetic stock out here. So I'm going to buy the call and sell the put. Okay. Now we call it a custom spread. It's actually a jelly roll. We just didn't label it as such. But the value is 60 cents. So I'm assuming there's some, whatever the interest rate plays out. So this is a 60-cent debit, right? And this is where we get into that carry between when July expires and gives us short stock to when October expires. That time period with the cost of money is going to, my guess is it's going to be around 60 cents. Is that about right, Mark?
Yeah, that sounds about right. Between October and July, we have what looks like about 90 days. So a quarter of the year, 90 over 360.
Yep.
360, and let's say about 1%. So that'd be 25 basis points times 694.
Yep.
And actually that comes out to about $1.70. So there is something else in play here.
Yep.
Effectively, the market's running a lower interest rate than 1%. So the market's running about like a 40 basis point interest rate.
Yeah, so it's probably it's not even 1%. And here's why: Tesla's probably hard to borrow, right?
That could very well be true.
Yeah, so it might be hard to borrow.
A reduced rebate.
Yeah, so you might not even be getting much anything. It's probably a reduced rebate. But it's a good point, right? You did the mathematics on carrying it. You say, wait a minute, there's an ARB here. Really isn't. You immediately said, wait, the interest rate is much lower in the marketplace, and we know Tesla, it can be a shorted stock. So my guess is that interest rate component where they're not paying as much on this short stock, right?
And I think that's a perfect example of why understanding these synthetics is really important.
Yep.
You make an assumption about where pricing should be, and if the market's telling you something different, it's a great opportunity to revisit what your assumptions are and why the market might be thinking about this cost of carry differently.
Right. Yeah, and you're exactly right. It's implying what did you say, 40 basis point? Was that what you said?
back of the envelope math, maybe slightly
Yeah,
lower.
that's about right. And that's 0.004. Okay. So it's not even 1% interest. So it's 0.4%. It's almost to the T what the number is.
Okay.
Yep. So it's definitely a reduced interest rate. So that's a good call. Okay.
And
Do
that's
you?
sort of,
Yep.
when we used to see these on the floor, right? If someone would come down with a jelly roll, your first question was always, what do they know about the interest rate or cost of carry that I don't? That this is definitely one of those trades that is going to take advantage of a potential change in that. So,
Yep.
if you have a company that might be under some duress or whatnot, and there's risk of that dividend getting cut, and you see a jelly roll come down to the floor, you're going to be a lot less likely to be on the bid for that jelly roll because you don't want to be short that back month stock if
That's
there's
right.
the risk of that dividend.
That's right. Exactly right. Those are all good points. So one thing I think we should do is let's do another video on the next topic, and that's when you have a front month or even back month for that matter of deep in the money situation in the front combo, and now you've got to roll it to a farther out month and then roll up or roll down. So now all of a sudden we're getting a little complicated. There's a box involved in that as well. Okay, an implied box kind of comparison. Because what happens is that most people say, hey, I don't want to be, if I'm short that front month call or put whatever, and it's in the deep in the money, I want to avoid exercise assignment risk. So I'm going to take that and roll it up potentially, and maybe in the same month or up and out in another month. All those work. So let's do that as a separate video because that's going to take a little bit.
Definitely. We just sort of went through the plain sort of vanilla jelly roll where
Yep.
it's the same strikes, but early exercise is a great reason why you might want to be adjusting those strikes over time.
Yeah, we'll hit
Early
that
exercise on either the call or the put side, right? Depending on if something's going in the money, either your short calls or short puts could be a risk.
Right.
There.
Right. And one of the big trades that we did back in the day on the floor, and I know one of my old partners still does this, is they would sell what we call a basket of stocks. So if the OEX has 100 stocks in it, okay, OEX, I think it's the 100. So there's 100 stocks in it, and they're all proportionally ranked and what their weight is. We would sell the basket of stocks, collect interest on that whole basket, and hedge it with the OEX combos, right? And we'd have to do jelly rolls because guess what? OEX expires in cash. It doesn't expire in all those stocks. So now you could have real risk where you have your combo expire in cash that no longer exists, and you're short all these stocks out there, right?
Yep.
Danger zone. So now we can't do that in the retail world. I mean, maybe you can if you have good portfolio margining. I'm not sure. Tricky in the retail world, but it's nice to understand the concepts of what can happen there. So maybe we'll add that stuff into the next one too.
And cash settled options are one of the more popular places that you see these. You don't tend to see these as often in the sort of like equity physically settled land, but in cash settled, they're very popular.
Very popular, yeah. So I guess you could probably do it in SPX as well. 500 products as opposed to 100. I think that's why the pro traders typically use the OEX to perform this function. And there's a real arb in the product. It was very, the good traders of rolls really understood when to make that roll and what the final print was in SPX to kind of tie that where your cash went out. So I think that's a whole episode though. That's a long conversation, I think. So, okay, good, Mark. That was good. So jelly rolls was this one. Rolling combos out. Okay. Understanding the interest rate components between months. Why they look like they do. Great epi. So thanks for that.
Absolutely. Something that seems so simple actually can reveal quite a bit about the dynamics of a product.
Yeah, that's right. Well, we figured out that Tesla's paying 0.4% instead of 1%. So we got that.
There you go.
All right, Mark, see you next time and have a great weekend and week. We'll talk next Thursday.
Yeah, thanks, Lex. You too.
All right, bye now.
Bye.